Hi, I'm Eric at Real Property Management in Blacksburg, Virginia. This is another video in our landlord education series. A couple of disclaimers up front. I'm not an attorney, so none of this should be construed as legal advice, and nor my financial advisor. So nothing I say should be construed as financial investing advice. I am a licensed real estate agent and a realtor in the state of Virginia. So today we're going to talk about the financial pillars of property investing. There's 4 pillars in property investing. Most people are familiar with cash flow. A few more people are familiar with appreciation, but there's a lot of people that don't understand tax benefits and leverage. So all these together attribute to the growth of your investment. Most people are just concerned about cash flow, but you can be in a negative cash flow situation and still be making money on your investment. So why do these matter? They're going to give you a little bit of stability in your investment. They're going to help you understand what's going on, balancing your short-term wealth and your long-term wealth. As I just mentioned, you may have a bad year. If you have to put a new roof on the property, if you have to replace an air conditioner system or maybe some major appliances, your cash flow may be negative for that year. That doesn't necessarily mean that that property is a bad investment or that you're losing money in the long term. And these pillars give you a framework to make educated, informed decisions about investing in property. So again, the cash flow pillar, most people are familiar with that. That's what a lot of investors, when they're first starting out, that's what they look at. Your cash flow is basically what's left over after you get the rent and pay all the expenses. So if you collect $2,000 in rent and you have $1,600 in expenses, you have a $400 per month cash flow. We're going to talk about some formulas to calculate how well this investment is doing. That's going to be in another video. So hopefully you'll subscribe to our channel and take a look at that video in the future. So the cash flow that's going to give you some reserves and some reinvestment potential. You can take that cash flow, put it into an account, and when that roof needs to be replaced, or when that appliance needs to be replaced, or when that air conditioning system or heating system needs to be replaced, then you've got money available to make those repairs. Appreciation. A few more people are aware of this and understand this pillar. This is the increase in the value of your property over time. And that can happen normally that happens through market growth. Price of housing historically over the past decades, the price of housing has increased. So just owning the house and not doing anything with it, you're going to make money. Then there's forced renovations. Then there's forced appreciation. That could be renovations or improvements. So remodeling a bathroom, remodeling kitchen, making some other improvements to the property. So don't confuse that with those renovations in necessarily increasing your cash flow. You may invest money, capital investment into putting a new kitchen in, and you may not see a huge increase in the amount of rent that you're getting, but you have increased the value of the property. And the third pillar, fewer people. And the third pillar, fewer people consider this when they're talking about property investment. And that's the tax benefits. Depreciation of the property reduces your taxable income. So while that property is appreciating and gaining value because the market's increasing or you're forcing appreciation through renovations. From a tax perspective, it's a depreciable asset. And so talk to your CPA or your tax advisor, and they can tell you how you depreciate that asset over time, and you can deduct that depreciation and reduce your tax burden. Any expenses that you have in running that property, think of the property as a little business. So any expenses you incur, repairs, marketing, if you're using a property manager, any expenses you incur, you're going to deduct that from the income when you're doing your taxes. And the fourth pillar, even fewer people think about this one, which is leverage, and that's using other people's money. This lets you control, say, a $500,000 home. Most, minimum mortgage payments usually 20%. So you put $200,000 down, and you're controlling a $500,000 asset. Now, you have to balance that with risk. Some of you may have heard of this BRRRR method of, buying a property, fixing it up, renovating it, renting it, and then reinvesting that money. You need to be cognizant of the fact that there may be some months when you're not getting rent on that property. So that's the risk. You need to balance that risk with the potential profits. So again, the four pillars of property investing: cash flow, that's your month-to-month income; appreciation, that's what is going to build that long-term wealth, generational wealth. That property is going to appreciate over time; your tax benefits; and your leverage. So hope you've enjoyed this video and found it educational. We have additional videos on our YouTube channel. Please click to subscribe and check those other videos out.